Debt-to-equity ratio is a financial measurement that shows the proportion of a company's financing that comes from debt compared to equity. It is calculated by dividing a company's total liabilities by its shareholder equity. The formula for calculating debt-to-equity ratio is debt-to-equity ratio times total liabilities from shareholder equity. Total liabilities include all of the company's debts and financial obligations, such as loans, bonds, and other forms of debt. Shareholder equity represents the amount of money that would be returned to shareholders if all of the company's assets were liquidated and all of its debts were paid off. A high debt-to-equity ratio indicates that a company has higher levels of debt compared to equity, which can suggest that the company is relying more on borrowing to finance its operations. This can be seen as a higher risk for investors, as it may indicate that the company could have difficulty meeting its debt obligations. On the other hand, a low debt-to-equity ratio suggests that a company has a higher proportion of equity relative to debt. This can be seen as a lower risk for investors, as it may indicate that the company has a strong financial position and may be more capable of weathering financial downturns. It's important to note that different industries may have different typical debt-to-equity ratios, so it's important to compare a company's ratio to its industry peers. When analyzing its financial health, investors and analysts use debt-to-equity ratio as a tool to evaluate a company's financial leverage and risk. A company with a high debt-to-equity ratio may have to allocate a significant portion of its cash flow to debt service, which could limit its ability to invest in growth opportunities or make dividend payments to shareholders. It's also important to consider the trend of a company's debt-to-equity ratio over time. A consistently increasing ratio may indicate that a company is taking on more debt to finance its growth, while a decreasing ratio may indicate that a company is paying down its debt and becoming less reliant on borrowing. In summary, debt-to-equity ratio is a key financial metric that provides insight into a company's capital structure and financial risk. It's a useful tool for investors and analysts to assess a company's ability to meet its debt obligations and to determine its overall financial health.